Bert Boksen is the co-manager of the Eagle Small Cap Growth Fund. He's up 42% for the year and 9% over 5 years. And he joins us now from St. Petersburg, Florida. Mr. Boksen, welcome to Bottom Line. Pleasure to have you on.
Thank you, Mark. It's a pleasure to be here.
Sir, why small cap stocks, especially in an economic downturn?
Small cap stocks are really the sweet spot to be in right now. You can see real unit growth at small cap stocks. Small cap stocks are being acquired by large cap companies. Large cap companies are flush with cash. Private equity is also chasing small cap companies. If you have a GDP growth at 2.5% to 3%, those larger companies need to acquire to get growth. They have the cash, they're on the prowl, and we've seen a lot of takeovers.
Well, Mr. Boksen, we'll get to that M&A theme in just a minute, but you have four main themes: accelerating earnings growth, catalysts like new management, reasonable valuation, and less volatility. Let's take them one at a time. What's driving the earnings growth of the small caps?
Small caps have more leverage on their income statements, so when you get a little uptick in the top line, you get big upticks in the bottom line. There were a lot of weaker sisters went out of business back in '08, and coming into '09, '10, 11, the strongers are surviving, and they're showing some very impressive earnings growth.
Mr. Boksen, what do you mean by catalysts like new management? Do you mean that new folks are coming in there and they're injecting new blood and new energy, and perhaps maybe being a little bit more risky in their attempts to acquire other companies?
Well, I don't know about risky, but if management isn't doing a job, you get new people come in to do the job. We tend to look for catalysts that'll lead to accelerating earnings growth. Sometimes it could be management, sometimes it could be an acquisition, a divestiture, a new product, a change in the marketplace, something that's going to change a historical rate of growth at those companies.
In this economic environment, what would you consider a reasonable valuation?
Well, the Russell today trades at about 15 times earnings, and most of our companies are growing much faster than the market, but it depends on the growth rate of the companies. But today, by historical standards, the Russell is actually trading in line with his historical averages. Large caps are cheaper than small caps today, but the action's been in small caps.
Well, Mr. Boksen, you mentioned the Russell 2000 index of small cap companies. It was up nearly 3% last week. If you're a company that has weathered the past 2.5 years and come out on the other side with a strong balance sheet, is now the time to start snapping up the small caps?
Absolutely. We're seeing it. You're seeing different M&A announced virtually every week. There's a couple every week. I didn't see anything significant this morning, but we've had several in the portfolio, as has most small cap managers.
Now, sir, let's get to some of your picks. Let's start with Genesco. You say it is growth at a reasonable price. Why?
Well, Genesco, they're growing much more rapidly than originally anticipated. They're growing very rapidly in the athletic business through their lids hat division. They're also just acquired a British company called Shoe. Comp store sales, they just reported last week, along with the acquisition, up 14%, and the stock has been rocketing. I think it was up about 12% in the last 2 days.
Yeah, one of the other ones you like, a very popular.
I think it trades at.
I'm sorry. Go ahead. I'm sorry.
Trades at 50, and it also trades at about 16 times earnings, so it's not it's not excessively valued.
Yeah, one of the other companies you like, very popular restaurant, BJ's, strong customer base and good cash flow. Is it also benefiting from the fact that some of its competitors are being closed?
Yeah, we got into BJ's back in '08 when we went to the restaurant for lunch, and it was packed. And all the other chains of casual dining restaurants around here had closed down shop. So there was a competitive void. They had a unique offering. And they're one of the few restaurant companies with lots of growth ahead. They only have 100 restaurants, and the stock's been on a tear in the last year.
Yep.
It's gotten a little expensive, but we still like it in here.
One of your other ones is Huntsman, family-owned company. A lot of people know the name of former U.S. ambassador to China and now Republican presidential candidate John Huntsman. Why do you like this company?
Huntsman's something that we bought at the bottom in '08, and the reason we were attracted to it, it was the Huntsman family at the time was buying in the open market millions of shares of stock. And it certainly reflected confidence that they believed they weren't going out of business. It had previously been an LBO deal they had with Apollo Group. That fell apart when the financing fell apart, but they had very strong lawsuit against both Apollo and against Deutsche Bank and Credit Suisse. They settled those for several billions of dollars. There was a shakeout in the commodity chemicals business, and the earnings and cash flow have been on a steady ramp upwards since then.
One of your other selections, OYO Geospace, a wireless company. What's the technology do for oil companies?
OYO has something they call their GSR system, which does wireless seismic. And so an oil service company, if they want to lay seismic, they don't have to lay cable. They can bounce their signals off a satellite. So they just have to put transponders at various locations, collect the data, and then ship it in, as opposed to having to put in a rugged environment heavy, expensive cable for tens of miles. Company's been extremely successful with that product. They've also been very successful with a new borehole product. Earnings should double this year.
And I do apologize because you are correct. The name of the company is OYO. My apologies. And finally, EMS Technology. It's being bought by Honeywell.
The EMS has been a long-term holding of ours. They have been, if you fly on a Delta flight and you want wireless, it's their antenna systems. They were started up as a defense contractor, had many iterations of different managements, and the new management was doing a very nice job. However, the company was being grossly undervalued. They were discovered by an outfit in New York who put pressure on the current management and board to put the company up for sale. And Honeywell bought them at about double the price that the stock was trading at pre-instigation, if you will.
Mr. Boksen, in our last 30 seconds, small caps, are they going to continue to perform large caps over the longer term?
Well, you know, I'm a small cap investor. I think you can pick good small cap stocks in almost any environment, as long as we have the factors in place where corporate America continues to need to grow. They continue to have the capital, low interest rates. It's a perfect environment for small cap companies to outperform today. There's no bubble in the small cap market. They're about 15 times earnings. And I would expect them to continue to perform very well, at least through the next presidential year, so that should give us another 18 months runway.
Bert Boksen, co-manager of the Eagle Small Cap Growth Fund, up 42% for the year, 9% over 5 years, joining us from St. Petersburg, Florida. Mr. Boksen, thanks for your time today. We really appreciate it.